Is the sound there? Well, that's kind of poopy. Look, I'll trim that part at the beginning. I'm going to give you the update. Hey, Craig, I like to not look at the computer for 1 second in the day. That's kind of my refuge. But you're right. Maybe it's time to rethink it. All right, so no sound. Thank you guys for letting me know there's no sound. Kind of a bummer. Creamy capital. Why is your capital so creamy? I don't get it. Need some of that test 1 2. Yeah, test 1 2. Here we go. I appreciate you, bro. Thank you for the heads up and for for letting me know that the sound's off. Sound game go weak. All right, let's get into it. So I'm going to just get on the chart. This is basically what I said in the part that you couldn't hear if you're not a good lip reader, is that markets are down this morning a little bit. On China and Nvidia front, China has approved the purchase of Nvidia H200 chips this quarter, and I said that Alibaba and ByteDance are looking to buy 200,000 units each. So that's putting a little bit of upside in Nvidia, but it's offset by weakness in initial jobless claims, which came out at 208,000 versus 210 expected, and a prior which was 200,000. So there's an continuous increase of initial claims, means it's a bad thing. More people are filing for unemployment. But I did also mention that it could be seasonal as retailers hire employees in December for the holiday demand and start to let them go in January to thin out the staff with the decreased demand. And then I said, let's turn around and look at the monitors and make a trading plan. So we're on to that part. I appreciate you guys for hanging in here. If you hung in with me and audio, you weren't hearing anything, then you guys are just real ones. I don't know what to tell you more than that, and I appreciate you. It's good to have a good circle of people, and you guys are that. So let's take a look at the chart. So I wanted to give you first some levels. These are levels that are called call and put walls. They're very important to me. The way they're derived is looking at 1 and 2 day expiry options on the SPX, on the index, and then calculating the basis by seeing what ES is trading at minus the SPX. Right now it's about a 40-point basis on today's session, and adding that up into the levels to convert them to the S&P 500 futures. So these levels to me are important. You can see them on the chart. The biggest one here is 69.89. There's about 6,000 open interests of contracts on the SPX. Mark that level on your chart. We start there. And then I start doing the trading plan. So what is the trading plan? Well, for me to do a trading plan, and pardon me, I'm going to cough. Oh, I'm still getting over this cold. For me to do this trading plan, I look at certain things that make a story. I like story, and I like that narrative of what is the story? What is the market trying to tell us? All right, well, we got to start out with the story in the U.S. session. All right, so whenever you're trading a day, go back at least 1 day, because all these things feed into each other. You can't tell a story if you don't have too much context historically. So market on the U.S. yesterday, we opened up at the 69.89 level. We had a little bit of upside, some rotation. The level we were looking at was 75 to 78. That was not a straight line up here to buy. We got the level very clean, and a lot of people will then pat themselves on the shoulder and say, good job, I got the level. But the thing to remember is there wasn't a trading opportunity at the level. It just one touched. It came down to the level and bounced and didn't really give us time to get into the trade. So I like to see the level, and then the entry opportunity for me is the rotation around the level. If we don't get any rotation or activity on buy and sell side for even a moment, it's hard to fill the trade on just a low tick, because you're just basically buying the dump. It's a falling knife at that point. So I missed that one. All right, it rallies out into back above the opening range, and we did get it on the pullback at 87 to 89 in the room. That was the level, but it happened after the trading room. All right, and so we caught this upside move. We said that be careful, because when you get to big even numbers like 7,000, oftentimes it doesn't break above 7,000. It'll go 98.5, 99 even, and then dump. This time it did break above 7,000, but we couldn't really catch a rally. There wasn't much buying interest above north of 7,000. Immediate failure. That's a price rejection of that level. When you reject a big key level, you're not going to pull back 5 to 6 points. You're pulling back 30 to 40 points. That's just the reality of it, because everyone realizes above 7,000, oh my goodness, the air up here is thin. Maybe there isn't the upside potential. Let's start selling. And then you get longer term position traders, medium term and day traders all on the sell side. And that's how this bottom falls out. And the bottom did fall out. It dumped below the open and into the afternoon. It set the prior day low, or the day low, then the 69.58. Rallies up, all right, and closes at 69.62, not too far off of the low. So the reason the story is important is it told us this. We had a bullish inclination in the morning. It was right. We crossed above the key 7,000 level for the first time. Like more often happens than it doesn't. We get smacked over the head after crossing that level, and we sell off. We form the low below the open, and the close is close to the low. That's a bearish day. That's a failure and a rejection of a new all-time high and a rejection of a key level. Doesn't mean we don't get there again. It just means we failed it this time. All right. So what happened? What's the story overnight? That's the U.S. session. All right. And I know it's some of you might be like, well, you know, I could see that on the chart, but trust me, you have to tell the story to yourself, because when the story is fresh and relevant, the trading plan is easy. The overnight story is this: small rally up to the 69.5, and that forms an overnight high. It's not a big rally. It's about 7.5 points off of the prior day cash close. All right. Selling continues lower, pretty brisk right into the downside. We set the overnight low at 35.25. Okay, and I'll tell you why this is all important in a second. In pre-market, we rebound a little bit, but we basically test and fail right at the prior day low. You guys tell me up to this point, hearing this information, what kind of trend are we currently in structurally? All right, where we open, we go strong, we reject the level, we dump, we close near the lows, we open the overnight session, drive lower, and we only rebound to the prior day lows. All right, there's very bearish inclination into this. Now, you could ask why and what's causing it. None of that matters. Yesterday in the trading room, one of our moderators, Fatty, said, I don't know, the market started to kind of knife down a little bit. He said, I don't know if there's news. And said, should I trade this before I know what's happening? And I asked him this. You don't get to do both when you're day trading. When you're day trading, you don't get to trade the sudden bursts of volatility. Pardon me. You don't get to trade sudden bursts of volatility and know why the volatility is happening. By the time you find out what's causing the market to move, the move is already over. Do you want to be on board, or do you want to know what's happening? Because those are two different things. If you want to know what's happening, go analyst mode. If you don't want to trade it and take advantage of what's happening and explain what's happening later, go trader mode. Two different things. When you confuse the two, you get problems. So here's the plan for today, all right? And the plan for today is very simple. Very first and foremost, we start 69.62 to 70 as marking this as our flip zone. All right, and what a flip zone does for me is very simple. It just basically says above, you look for long opportunities, below you stay short. Flip zone is very important because before the opening session, you're writing a level and you're setting it based on your data and your analysis of where the structure changes. So when you get into it psychologically throughout the day and you burn out some mental capital and your brain's a little more mush, you're not fighting with what am I supposed to do. You know exactly what you're supposed to do, when and where. So above this level, we are going to look for longs. But today, I'm going to start bearish and get myself convinced to be bullish. And the reason this is the way I'm going to go is the story tells us we have to be bearish below this level. You could see a lot of delta was kind of playing out, 62 to 64. I looked at the order flow charts, a lot of buy and sell imbalances were also at this level. There was a fight. So structurally, if we could get north of 69.5, we're buying pullbacks. All right, I would like it. These are the trades. I would like it at 69.5 to break, retest, and kind of give me a few rotations to get in. It doesn't have to be that clean. I'll still take advantage if it doesn't happen because we got buy stops now to the upside. But I'm going to start with a bearish bias and allow the bulls to convince me to change into their direction, because everything right now, the story is telling me downside could get opened up for the daily session today. All right, and if I'm starting on the side of the story, then I get convinced to get opposite side, I'm going to have a stronger edge than if I start with the contrarian idea of this thing is down, I'm going to buy it. All right, because if you're bullish when it's bearish and you get convinced bearish, you're already on the losing side. You're going to get knifed up first. Streets also, I love the footprint charts. This one here is a 24 tick reversal chart that you're looking at. This is my bread and butter for the trades. Basically the white chart on the left, and I have more going there, big long monitor. The white stuff on the left is analyst mode. The dark stuff to the right is get to work in sniper mode. So I love the 24 tick chart for levels. You can see here, there's an imbalance that's red and an imbalance that's green. These are pretty much the basis of all my entries as an order flow trader. Not just see them and buy and sell, but they start setting up the pattern that I look for. Still difficult for me to stay in good trades. Street Salsa, we could talk about that a little bit if you want. Let me just finish up the plan. All right, below 62, we're looking for the short. I covered the bullish scenario. You know, I'd like to see some activity here and some stuck long positions that aren't getting paid, and the book flip to the sell side to push us lower. Where I think the market really opens up to the downside is the 35. And where I think the contrarian trade is, if we get down to 35, we can't break it. There is a long opportunity there for the fade trade. And I'm not saying I won't take it just because I'm bearish, but the 35 quarter right here at the overnight low is going to be a very, 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 very key level. We break below it, you're going to get that downside to open up. All right, that's going to be the big paycheck day. From 62-ish or so down to there is a paycheck. Below 35 quarter is the big paycheck. It's a big one if we could break it. All right, that's the trading plan. Any questions? The plan is to watch order flow early on the open, and as soon as it opens, start to watch the big orders, how they flow through, find the momentum. If the bear side that I'm starting out on is correct, there'll be a trade. If there isn't, I'll be convinced to get long, and I'll have to buy it higher up. But remember, I like buying higher up, especially if I start with a bearish bias. A lot of people think that if they miss their trade, there's something wrong with paying 10 points more to get in later. The reason it's 10 points more is because you have more confirmation that the bullish trend is coming in intact like you expected. Therefore, paying more is a good thing. Paying more means you're investing in something that has probability. Paying more means you're already seeing your analysis come to life, and you should be paying more. That's price acceptance. All right. Street also, let's talk about what you mentioned. It's still difficult for me to stay in good trades. What would you say is the difficult part for you? Like, if there's many reasons that could be. All right. And one of the things for me when I struggled with it is I was looking at the footprint chart too much and at the wrong times. That's oftentimes the culprit for not hanging on to good trades for order flow traders for longer. And the reason the reason that's the case is the information here is changing so quick, and when you're entering a trade, it's so relevant, and all you're focusing on really is on the footprint and the order flow, that you attach to that really fresh data that comes in so quick that you think every moment of it is important. But once you're in the trade and you have a target level upward, you stop looking at the footprint chart as much. It becomes less relevant because it has more opportunity to head fake you out in a short-term moment versus the trend in what you're targeting. So the way that I dealt with that personally, Street Salsa, is I did half in, half out approach. So if I get in, my half target would be at the first footprint resistance level. So let's say you were to get long and you're in the trade, but 5 points above on the ES, you have a big sell imbalance that you look at and you're like, well, look, this is telling me to sell. Don't ignore it, because if you ignore it, you're going to bring emotion into your trading. Acknowledge it and take some off. All right. So if you have 4 contracts, let's say take 2 off at the next level, do the right thing, trail stop to break even, and then start to look a little bit higher up and say, look, order flow right now might look slightly bearish, but I'm going to kind of unanchor from this moment, pull myself away, detach, and look up the chart and say, where's my real target here? All right, 68. Let's see if I can get the 68. And then I trail on swing lows on the chart here. You know, put the stop here. If it goes up, does a higher low, put the stop here. And that's the context. The biggest thing, though, to remember, guys, and I got to get off and head in the trading room, but the biggest thing to remember is the only time you're going to get the maximum of the move from tick low to tick high is in replay in past environments. You're never in a live trade setting going to get a top tick beneficially. You are going to get stopped out on a low tick, and it's going to frustrate you. but you're never going to get the tick low to tick high. I call it the pineapple. You don't eat the pineapple top or bottom. You cut that and you eat the middle. And so you're always going to be eating the middle of the pineapple. So get used to it, but you can maximize how long your pineapple is. And I do that slowly. I start targeting a level. It has to be level based and not arbitrary. So if you're like, I need to get 12 points out of this trade, that's a terrible approach, because 12 points in the market today is not the same as yesterday. These points are harder to come across on some days and easier on other days. 12 points is low for a trend day. 12 points is a lot on a range day. So set the level, get your trade normally if you're comfortable with that process. Your initial target should be scaling out of some of your position based on order flow. You got in on order flow, scale out on order flow, and then the runner, the balance of it, unanchor or detach from the footprint and look more positionally in terms of trend context to trend follow. Does that make sense? Was that helpful to you? The delta imbalance, Pencho, is 1.5, 2, and 5 on the footprint chart. That's what I have. 1.5, 2, and 5. And I give you that template if you want. It's not, there's nothing secret about it. It's just, I'm not a guy to sell you proprietary stuff. This is my proprietary trading system that I've calculated. 1.5, 2, 5 for the imbalance. And sometimes it needs adjustment, very rarely. Just ultra high volatility days. Guys, that's what I have for you. Thank you so much for putting up with my audio issues this morning. Craig, maybe you're right. Maybe it's time to abandon turning my back to the data. How will I sleep? It's the part I love the most. Pardon me. If it's a different platform, Pencho, try 3-to-1. 300% is a good neutral ground. Traded 300% for a very long time, 7+ years. Never had any questions about it. It's a solid thing, and then increase to 5 as well. If your platform allows you to highlight both in a different shade, 300 should be your opening imbalance, and then 500 should be kind of like a darker color because that's a more extreme imbalance. Make sense? Appreciate you guys. Have a great day. Love you all so much. Thank you for tuning in. Thank you for your patience. We're going to sort out this tech issue. I forgot to turn on the mic. It's my fault. It's not a tech issue. It's an operator issue. I love you all. You guys have a good day. You got the trading plan. You got everything you need. And I will see you tomorrow at our next morning market update, the last one for the week. Remember, non-farm payrolls pre-market tomorrow. So have your head on a swivel. Once again, love you. Have a great day. Goodbye.